Trading right around the $144 to $148 price corridor, Abercrombie and Fitch Co. continues to shatter every conventional mental model held by traditional retail analysts and algorithmic short sellers alike. For months, Wall Street commentary has been trapped in a lazy recycling loop, dismissing the entire specialty apparel sector as a commoditized casualty of consumer spending fatigue, inventory bloat, and transient post-pandemic demand spikes. The mainstream consensus narrative loves to treat apparel retail as a flat, uninspired landscape where brands rise and fall on the whims of teenage mall culture. But that superficial framework completely misses the structural reality and operational physics of what is actually happening underneath the hood at Abercrombie and Fitch. This isn't just a clothing company catching a lucky seasonal break. It is a masterclass in digital-first inventory velocity, agile supply chain engineering, and a total brand architecture overhaul that has fundamentally rewritten how modern retail cash flows are generated. While retail investors on social media platforms and standard financial media channels obsess over macro noise, inflation data, and short-term consumer sentiment surveys, institutional smart money has quietly recognized a powerful truth. ANF has transformed from a mall-based relic of the 2000s into a lean, highly localized omni-channel juggernaut. The hidden bottleneck that legacy retailers failed to solve, balancing inventory precision with full-price sell-through rates, has been systematically conquered here through advanced data analytics, disciplined global sourcing, and a localized marketing playbook that treats consumer geography like micro-markets. When ANF prints record second-quarter net sales of $1.27 billion, marking its 15th consecutive top-line growth, and delivers an adjusted earnings per share print of $4.17 that utterly obliterates consensus estimates, it exposes a massive valuation mispricing. The market spent the first half of the year pricing this stock as if its historic turnaround was a cyclical peak, ignoring the structural margin expansion and structural cash generation engines that continue to compound beneath the surface. To truly understand the violent upside repricings that characterize ANF's trading action, such as its massive single-session surge following blockbuster earnings and raised full-year guidance, you have to look closely at daily trading volumes, institutional accumulation patterns, and the perpetual tug-of-war between retail jitters and institutional conviction. Ahead of recent prints, short interest and bearish positioning often swelled as nervous retail traders attempted to front-run a perceived consumer slowdown. Yet during every minor pullback or macro-induced jitters phase, heavyweight institutional allocators, firms like AQR Capital and other quantitative and fundamental powerhouses, quietly scooped up shares, methodically building multi-percent stakes. When a company actively repurchases roughly 7% of its total shares outstanding in a single year, targeting at least $500 million in share buybacks, it creates an aggressive built-in demand floor that squeezes out late shorts the moment an operational catalyst hits the tape. This dynamic is amplified by the sheer efficiency of management's capital allocation framework. Rather than sitting on idle cash or chasing reckless diversification, leadership is aggressively returning capital to shareholders while simultaneously funding high ROI store experiences and international expansion engines. The market often underestimates how quickly a tight float combined with aggressive buybacks can accelerate earnings per share growth when operating margins expand towards the 15 to 20% range. Before we break down the operational mechanics and historical evolution of how this iconic brand engineered its renaissance, let's pause for a moment. Where do you currently stand on ANF? Are you actively accumulating shares during these post-earnings consolidation phases, waiting for a deeper macro pullback to initiate a position, or sitting on the sidelines watching this turnaround rewrite the retail playbook? Drop your thoughts or share your positioning metrics below.